All right, let's begin. Okay. Hello, everyone. On behalf of the Counselors of Real Estate and the Real Estate Executive Council, it is a distinct privilege to welcome you to this session of What's Next for Real Estate and the Life Experience, Capital Flows in the Post-Pandemic World. Thank you for joining us. I'm Michel, Couillard, 2021 Global Chair of the Counselors of Real Estate and President, CEO of Busac Real Estate and Equities in Montreal. The Counselors of Real Estate is a distinguished international group of accomplished leaders solving complex real estate challenges, experienced, innovative, and credentialed problem solvers. Counselors practice in 20 countries and offer expertise in more than 50 real estate disciplines across all asset types and classes. Each has earned the prestigious CRE designation. This webinar series represents the very essence of the compelling thought leadership for which the Counselors of Real Estate is known. I'd like to offer you a complimentary subscription to our peer-reviewed professional journal, Real Estate Issues, by visiting cre.org/publications with an S. And to learn more about the Counselors of Real Estate and its 1,000 CRE credentialed professionals, please visit cre.org. The Real Estate Executive Council, REEC, is a professional trade association of African American and Latino commercial real estate professionals. REEC's mission is threefold. Number one, to create opportunities for relationship development and access information that will lead to increased business opportunities. Two, to support organizations that seek to increase the numbers of diverse professionals in the real estate industry. And three, to promote education and advancement of minority professionals in real estate. We have the honor today we're privileged to hear from REEC's chair, Tammy Jones, who will be introduced momentarily along with the rest of the superb panel. Also part of audience is REEC's CEO, Ken McIntyre, who's also available for questions at the end on our Q&A period. For additional information on the Real Estate Executive Council, visit reec.org. That's REEC.org. I'd like to recognize our sponsors for What's Next webinar series, the Altus Group, Equus Capital Partners, and Real Capital Analytics. Thanks you, as always, for your support. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcome, and we'll answer as many questions as time allows. I'm honored to introduce Moderator Sharon Ann M. Miller, CRE, also known as Sam. Sam is President and Head of Portfolio Management of Hillcrest Finance in New York City. In her distinguished 30-year career, she has held many notable positions, including Managing Director at Rockwood Capital, Global Managing Director at Tramwell Crowe Company, Managing Director of Investment Strategy at Hart Advisors, Vice President of Portfolio Management at JP Morgan Investment Management, Vice President of Marketing and Client Service at O'Connor Capital Partners, and Vice President at TIAA Craft. Sam was invited to CRE membership in 2004. Welcome, Sam.
Michel, thank you so much. And I'm trying to think how I feel about that introduction. Either it says I'm experienced and I may have something to say, or that I've just been doing this for a long time. So let's hope it's the former. I'm really happy to be here. I'm even more happy to be the moderator of this panel. It's my pleasure to be on this panel with this distinguished group of real estate leaders. These are women who have been in the industry 20 plus years and have demonstrable track records, and they are formidable in their field. So I think this is going to be an enjoyable conversation. We've already asked that we get cut off because we do often have great dialogue. So I think this is going to be one of them, and we appreciate you all joining and listening in on the dialogue. We also do hope that you'll have questions, and we're happy to answer those questions at the end. What we really wanted to do today was just share with you our thoughts and perspectives from our different perspectives on capital flows. People often have questions on where the flows are coming from and where the flows are going. So which property sectors, geographies, types of projects are winning, so to speak, particularly in this type of market. So with that, I am happy to introduce the panel here. For more than 25 years, Christy Fields has contributed and consulted to global institutional investors structuring and execution of their real estate portfolios and platforms. She is known for providing solutions that transform portfolios from, money participants to money makers. She is an owner and member of Meketa Investment Group's board of directors. And in addition to her responsibilities as the head of the real estate portfolio solutions team, she also leads the firm's diversity leadership committee. She is a participant and member of their investment committee, as well as their private markets research team. Christy received her undergraduate degree from Cornell and her master's from Yale. Welcome, Christy. Next, we have Tammy Jones. Michel mentioned Tammy, in addition to her responsibilities as chair of REEC. Tammy has more than 20 years in the commercial real estate industry. She's invested and continues to invest in all parts of the capital stack, equity and debt alike, for global institutional investors. Tammy is the co-founder and current CEO since inception of Basis Investment Group. They're based in New York, and it's a private equity real estate investment firm. Under Tammy's leadership since inception, which I believe was 2009, they have invested in over $4 billion of commercial real estate, including multifamily as well. Tammy received her undergraduate degree also from Cornell, feel outnumbered here, with a concentration in real estate. And then she got her graduate degree from Georgia State University. Tammy, thanks so much for joining us today. And then finally, we have Jillian Hellman. Jillian is a trailblazer. She's a thought leader. She is the founder and CEO of RealtyMogul. And I believe RealtyMogul was just named the #1 crowdfunding platform by Motley Fool. And that is certainly a feat. There are a lot of crowdfunding platforms out there, but Julian's team and platform has transcended all that is investing at that level. I'm sure we could have an entire discussion on this capital source. Many people are interested in it. A lot of people don't know about it, but I think it's something that is going to be transformational. So Jillian, you may get roped back into joining us again for your own separate session on crowdfunding. So thank you so much for being with us. Jillian has a full plate. She has been on Bloomberg, CNN, kind of talking about this platform. So we're grateful to have her here today. So let's start our discussion. And I think, Christy, I'd like to start with you. There's a lot of talk about capital, the sources, where they're coming from and where they're going. From your perspective, because you sit kind of at a strategic level and invest in our advising institutional investors across the globe, would be great to hear from you if you would share some examples of how your investors have looked at investing in this market. So in the hot seat of the pandemic, which is kind of, let's call it mid-2020, the improving pandemic, let's say post-vaccine, so that'd be early 2021, and now kind of mid to late 2021 when we're seeing potentially a reversion back to what we were seeing before. Share some thoughts with us.
Yeah, thanks, Sam, and thanks for having me. It's great to be here with this group, especially. I think we were like a lot of different folks and our clients where, we took that moment and just paused and tried to figure out what was happening and what some of the ramifications might be, and just to see how things might play out. And then I think we all realized that COVID was going to be a longer duration event than any of us hoped. And there's, people still had fairly significant allocations to real estate, to other private markets, but to real estate specifically. And, we definitely picked our pencil back up kind of towards the end of summer and have been busy since, quite frankly. The thing, and I'm glad we're talking about this, because it's something that I think about a lot and I worry about, is just the significant amount of capital that's coming into all parts of the real estate market. And just in the last 2 months, several of my largest clients have increased their allocations. They're already sizable allocations, but their allocations to private real estate. So those are significant dollars that are going to only sit on top of what's already been raised and available for investment today. But I would say when we first restarted underwriting kind of in the late part of summer and into the fall last year, we were really spending most of our time in sectors kind of that were benefiting from COVID, where we could get a little bit more comfort about go forward underwriting assumptions, occupancy, and rent growth. So those were industrial, some part of the resi markets, life sciences, data centers, and the like, not unlike a lot of participants in the market. And then we've pivoted somewhat to underwriting then a good mix of diversified managers, so managers who can kind of pivot across the markets as they see trends unfolding and opportunities arising in more perhaps pocketed circumstances. So it's been a real mix for us since the beginning of the year, but the pace has been unabated, and if anything, is accelerating.
I want to get to where the winners are and kind of what things are winning. But before we do that, tell us, where's the capital coming from? Is it U.S. capital? Is it international capital? Who's really kind of moving full steam ahead?
I think it's a very wide variety of capital sources. Certainly U.S. investors, but you also have a handful of Asian investors now who are newer to kind of private real estate investing. And so we're seeing a lot of capital flow there as well. I just haven't seen a fall off of capital allocation really from any particular group of investors. It's been fairly steady state.
Okay, great segue to Jillian, because your firm is focused on a whole new set of investors that are now piling on to the institutional capital that is out there. What say you about the capital that is coming from your group of investors, and maybe give us a little sense for how it has evolved over the same period of time? So when we first kind of got in the throes of COVID to now.
Yeah, sure. So the majority of our capital comes from high net worth investors. RealtyMogul is a digital marketplace. So we connect investors with direct real estate transactions across a variety of different asset classes, family, office, industrial, retail. The majority of the capital is coming from accredited investors. So high net worth investors, there's not really an average investor per se, but it's typically investors who have between $2 and $5 million of net worth. So they've got, good liquidity, they've got decent net worth, they're looking to deploy capital into the private real estate markets, typically, allocated in stocks and bonds, and are looking for alternatives and the ability to sort of direct their own portfolio. I would say very similar to Christy, early 2020, it was the great pause, right? And that was as much on our end. We sort of forced it on investors because we said, let's take a breath, right? And we didn't originate any new deals for a couple of months. And then we started to take some calculated risks. One of our core values at the company is calculated risk, where thorough analysis and allows us to take a position, right, in times that are tough. And so we really leaned on that cultural value when COVID hit. And we did a 2-property portfolio in Dallas that was a value add portfolio. I joke with the team, it was like the only COVID discount deal that I think that we really did, because multifamily just came back like so hot. And it was challenging to predict that, but we've made a lot of investments in Dallas. We were very, very comfortable with the submarket. We were very comfortable with the business plan, very comfortable with the operating partner. So that was sort of our like COVID discount deal that I think that we did. And then we did another deal, and that was fully funded by retail investors. So it was north of $10 million that was invested in that asset. And then we did another transaction that was north of $10 million invested, which was actually a deal in the heart of Las Vegas, Nevada. And so you might look at us investing in the heart of Las Vegas, Nevada in the middle of a pandemic and go, what fools. But again, it was a calculated risk. So that was a triple net deal to NV Energy, which is one of the largest energy companies in the state, owned by Berkshire Hathaway. We got really comfortable there. It's a covered leasing play. And so we were cautiously optimistic about a couple of transactions. The interesting thing that was happening sort of in the mid-pandemic or even early pandemic, like May, June 2020, where there was still a lot of fear, right? It was still unclear if you got COVID, that was a death sentence in and of itself, despite, all the things that we know now. Capital was never a challenge. We found that investors were still active. We never did a transaction that, we couldn't finance 100% of. And then it started to ramp really, really, really aggressively by Q3 of last year. And in talking to a lot of these investors, again, we've got a network of over 200,000 investors, and we're constantly having conversations with them. A lot of the conversation was around, my stocks are doing so well that I'm now under allocated to alternatives. So because my the stock market's going up and my value of my stock portfolio is going up, I try to keep sort of in balance with my alternatives. And so we saw a tremendous amount of interest in real estate. And then today, we've had our biggest last 12 months ever since starting the company. In the last 6 months alone, investors have used the RealtyMogul platform to invest in over $800 million of real estate across 21 projects. So we've seen a lot, we've done a lot. I'd say today we're cautiously optimistic. We're watching the Fed decisions around interest rates really carefully. We still are bullish on multifamily, although pricing has moved and cap rates have compressed. But there's still a tremendous amount of appetite from the retail investor. And we continue to see that, in full force, just month after month after month in the dollars that are flowing through the platform.
Yeah, that's, let's take that because, so we all agree, capital really didn't slow down. It may have stopped, taken a pause, but it's still out there and willing and ready to invest. With that being said, give me a sense, and maybe I'll let Tammy guide us through this conversation. And I would love to hear from each of you after kind of Tammy sets us off, is what property sectors are seeing the most activity? And let's try to go beyond our favorites, the darlings, the industrial, the multifamily, because we know that in any given market, those are the safe haven. Let's try and see outside of those, Tammy, if you could, what property sectors are you seeing the most activity? And maybe it's all the property sectors, and maybe it's a different life cycle. Maybe some are seeing more construction. So maybe we can have a little bit of a relative value discussion with life cycle, market. Maybe some markets are, more, conducive to multifamily, and other markets are more conducive to office. So maybe set us off on a conversation about what property sectors, markets, life cycles are winning.
So I would say that we are living in a tale of more than two cities, because local geographies can be remarkably different. We can talk about the urban infill versus suburban, and COVID is affecting these areas differently because of what we have now been coining the phrase of densification, and so we saw a lot of migration out of the urban infill markets as a result of COVID. And so in terms of geographies, I would say that the middle market has been winning. And there are those of us that believe, I'm a New York City girl, so there are those of us that believe that the cities are resilient and will come back, and I believe that they will. But I think the recovery is different. So I would say the middle markets, certainly the Southeast is on fire. Markets like Texas, Atlanta, Charlotte, Salt Lake City, Utah, places where have been called the Silicon Valley in the West. There is so much capital, as we've all highlighted and discussed, on the sidelines, but geographies, depending on how the vaccine has affected these markets, will be different depending on where you go. As it relates to property types, now let's talk about that. So there is so much capital in multi, and Sam, you hit the nail on the head. That's the darling, but it really is about supply and demand. If you look at cap rates, they are so compressed in some markets. They are sub 4. Like, I'm looking at places where it's 3.5%. That is not sustainable. So we need to be careful with multifamily. That said, in the last crisis, I founded my firm in 2009, in the middle of the GFC. We certainly saw the wave of recovery, and we know that there's opportunity in these sectors. But I would say there was a oversupply of luxury multifamily. there's still an affordability crisis in America in housing. So there was not a lot of development of workforce housing. So there is a tremendous opportunity, because I think when we say multi or retail or office, we have to break them down. We have to break it down between luxury, oversupply, and in the run up. Workforce housing, we still need a ton of it. So we've been investing a lot in workforce housing and affordable, either providing debt or equity, and we're seeing returns and yield there, and we're seeing investor capital go to some of the urban projects. As it relates to something different, well, Basis had a thesis on drug and grocery anchored retail. And if you think about COVID, we had two things. We had shelter and food. Shelter being housing, and food, we needed drugs, for to get ourselves through the pandemic. And we certainly needed groceries. And our focus was, what is less vulnerable to Amazon? Can you get your nails done, on Amazon? I guess you can get some kits, but certain things you have to actually be physically present for. And I think as, humans, we want to actually interact with each other. And so we had a thesis on drug and grocery anchored retail prior to the pandemic. And that portfolio, which is over $100 million that we've invested, really was a winner, because everything, collections went down in the March and April period of 2020, but certainly came back. And so, in that portfolio, collections are over 90%, occupancy is up, and we're seeing, recovery. Now you have to watch that sector because of the variant and so forth. The industrial, we see a ton of capital going into that. We're starting to see opportunities in hotels, more destination-oriented hotels. I mean, this summer, you couldn't get a room in many destination places, and rates were ridiculously high. And so we have actually only 3 hotels in our direct portfolio. We were pretty excited about that because that kept our exposure pretty limited to that sector. But those hotels are all open and doing really well. And then you also have, life sciences. We got to be careful about the overdevelopment and everybody rushing to that sector. And also we need to pay attention, to tenancy as well. And then office. It's in a transformation. It's early days to see exactly what's going to happen. However, we all are going to need offices. The question is, will office be right sized the way malls were? We were over malled in this country, and now we're seeing that, that sizing come back. And so I think if you look across the globe, you will see office in most sectors across different countries are going to have to, figure out what the right office utilization and space is. And so we're really paying attention to utilization. And I think that has yet to play out.
I think what's interesting, and maybe a little bit of a pushback, not on what you're saying specifically but about this concept that this migration that we're seeing just happened with COVID. I think we were seeing a migration happening well before COVID. Born and raised in Connecticut, one of the worst states for taxes. People were out of there before that. So people were moving for different reasons. I think COVID came about and just gave it a boost. So I think when we think about the changes that we're seeing from COVID, we have to remember that they were happening before, and why were they happening before, and have those things changed at all, and how that affects or how that works with the COVID effect. One of the things that you mentioned, I would love to hear Jillian's thought. You do both equity and debt in your investing, and have you seen a preference based on what people are thinking and how they're feeling about their portfolios, where they want their money? Are people more interested in equity investments, debt investments? I'm sure both Christy and Tammy can jump in and comment on that.
Yeah, we're predominantly an equity investor. So majority of our volume is, tried and true joint venture equity, limited partner equity. We've done some prep equity. We had a lending platform until 2015. And what we found was lending is largely a commodity. And we didn't want to be a commodity platform. We really wanted to give investors something that they couldn't find elsewhere, and something that they couldn't source elsewhere to, add value and make it easier to invest in real estate, sort of aligned with our mission of helping individuals to get exposure to real estate investments to live the lives that they want. So majority of our production has been equity. But something that it may be interesting just on the note of property type. So we survey all of our investors on a regular basis. And in the midst of COVID, we did a survey of what property types are the most interesting. And in order of preference, it was multifamily, single family rentals, which we haven't talked a lot about, industrial, retail, office, and then hospitality. I agree with Tammy, like COVID has accelerated the work from home trend, and we don't know how much office is going to become obsolete. The hospitality one was interesting. We're also not big investors in hospitality. We had 2 hotels in the portfolio. Didn't make an investment in hospitality since 2015 because I really view it as more of an operating business than a real estate business. And I personally believe that, hospitality is some of the worst risk-adjusted returns in real estate generally. But I actually think there's some opportunity there today. So surprising to us when our investors said, we really don't want to invest there, even though it's obvious to everybody that that's very distressed. We're not originating in any hospitality, very little office. I think there's interesting opportunities in retail. I mean, retail has gotten so hammered and there's so much fear around it that, when you can generate double-digit cash-on-cash returns on retail where you've got tenants that have good credit with long-term leases of 10 years and you're going to get out 100% of your principal just through the cash-on-cash, like that feels like a good risk-adjusted return to me. So we've looked at some retail deals like that. We've done some grocery-anchored transactions where we've got grocery-anchored centers with really high cash-on-cash. And there's a mismatch today between where cap rates are in retail and where the debt markets are. So the debt markets have gotten very competitive in retail again. You can get debt with a 3% in front of it, and you're buying retail typically at a 6 or 7% cap rate. So the spread there is really, really interesting on the retail side. And then we're also working on a single-family rental pool right now. We've seen a lot of appetite for single-family rental. Individual investors, individual accredited investors, they understand that business plan, right? A lot of them own their own homes. And there's been a tremendous amount of institutional demand on that side as well.
I would just, if I could, Sam, jump in on the debt and equity. So we are a diversified platform, and we think that we actually bring value to our investors by being able to pick targeted positions across the capital stack. And not all debt is a commodity. I'm going to push back a little bit, Jillian, on that.
I was waiting for that.
certainly senior debt, very, highly competitive. But as we're searching for yield, we have to be more creative about building out our capital stacks. And so there's pref equity and structured equity and mezz and, what we call dequity, which is a combination that really is very much, like equity, but you actually have downside protection in terms of structure and you have a preferred return. And I feel like those types of structures can be accretive to platforms that are doing equity. So we try to come up with very creative and innovative structures, in this pandemic. And by the way, Sam, I wanted to come back to your point. I completely agree that the pandemic accelerated things. And I think it's excellent that you pointed that out because we sometimes get thrown into the pandemic did all of this. It accelerated retail, it accelerated migration. But I also think it's accelerating some of this need to be creative because when you have all this capital coming into these structures, it's going to affect yields and you're going to have to figure out how, if we have all this equity, I mean, at some point, it's really going to create what I have seen in terms of these market disruptions, behavior that is on the underwriting side that gets aggressive because both on the debt and equity side. And so I would say that we do a lot more debt at this point than we do equity, but we are now LP allocators of equity as well. And so we're seeing our pipelines have never been more robust, which is great, but it also should be a sign of caution for all of us because it really the coffers are open, but I believe you still have to be selective because there's a lot of things in this cycle that haven't completely played out.
What say you, Christy?
Yeah, I couldn't agree more about being creative and approaching each deal kind of uniquely because I think just as the last conversation has highlighted, real estate, I think there are opportunities across all sectors, really. It's very hard to just use a broad brush for any of the sectors, be they, COVID hot or COVID not sectors. I think to your earlier comments, Sharon, right, we were seeing kind of that the nexus of migration trends, based on cost of living, based on opportunities, based on educational opportunities, and then with technology, right, and how technology has been transforming our lives and how we interact with the built environment. And I think those things are really kind of coming together to across property types, but you'll have properties that have particularly great submarket locations that are new or have had significant redevelopment dollars put into them and are meeting people, where they are and where they want to be and how they want to use real estate. So But there are neat office opportunities. There's some very interesting retail opportunities, even in those sectors that are kind of currently regarded more broadly with caution. But I think that's the real thing. We have to be really observant and identify which individual assets are best positioned to meet kind of users' needs on a go-forward basis.
Agreed, 100%. And I think when I think about the folks who are investing that capital, and I'm going to be very mindful here, I don't want to get gonged, but I think it's those firms that are smaller and nimble, who have the ability to kind of target and be more target because the capital dollars can be more focused. It's not, like Jillian said, a commodity issue. It's really about finding the right investment opportunity at the right time and putting those dollars to work. So when I think about the folks that might be on this call from the CRE, they're smaller owners and operators, and for whatever reason, those kind of institutional capital sources may not be there for them, right or wrong. But I do think that there is an ability for the smaller, more boutique targeted firm to come up with those solutions for a market that needs solutions. I want to shift a little bit. We talked a little bit in this conversation. I knew this is exactly what was going to happen, is that we were going to kind of weave in all the things that we wanted to speak of and kind of really get into a dialogue. One of the things that we talked about is lessons learned. What is it? We've all been through several cycles, and they're different. I do think that when you think about a cycle, in this cycle, we got a lot of inquiries from investors thinking that, oh my gosh, this is it. We're going to have all this distress and we're going to pull all this money out and get all these investments on cents for a dollar, cents on the dollar really quickly. And as we know, it just doesn't happen that way, right? There are themes that happened. Liquidity was the first thing that happened. Banks, everybody kind of pulled back. You all said it. We stopped, thought about it. So, that was the liquidity issue. So there were opportunities there. Were they distressed? Maybe not. Then we had this period of time where that we call the extend and pretend, or the kick the can down the road, whatever you want to call it, where people are just kind of, let's wait and see what happens. And then you start to see it move through the cycle. So when you all think about the lessons that you've learned over the years, what are you doing differently this time than maybe you were doing before, as you work through the cycle, understand what's happening, and try and come out on the other side? I'll leave it to anybody to start us off. Tammy, you want to start us off?
Sure. I was being respectful. And by the way, I wanted to say thank you to the council, because this is one of the first all-female panels that I've been on, and I just want to give a shout out to that. I should have said that in the beginning. So for us, as my esteemed panelists also mentioned, we did the triage thing, went through our portfolio, and certainly that was the first phase of this. And so that's very similar to the great financial crisis, kind of going through your portfolio and figuring out where you are, what is the stake. But then as you move forward, it's this cycle felt so different to me and to my firm, because it was more collaborative. This wasn't folks over levering and mismanaging things. I mean, every one of our investments was performing amazingly well, and the light switch went off, right? So this was not about trying to figure out how to get control of something. This was a spirit of working together, because we were in this new normal, this place of disruption. And so what we decided to do, which I think was a bit innovative, as my investors have mentioned, was to not do the forbearance and just, kind of kick the can and do what everyone else was doing and spend money with lawyers and, trying it in our credit portfolio. We actually provided rescue equity. And we basically said, what would we have done differently if someone said, Tammy, this was going to happen? Well, we would have infused reserves. So we created reserves, debt service reserves, call it 6 months for some assets. We did this, and I'll give you the case study was the 3 hotels. We did this for our hotel owners so they could focus on operations. And we said, let's not do forbearance, because at the end of the day, the money's all due, whether it's forbearing it later or us giving reserves. By doing this sort of rescue equity to basically pay or provide reserves for taxes, insurance, and debt service, we were able to pay our line provider. We were able to continue to keep our investors current with the cash flow. We were promising a 10% return. And it was only 1.5% of our equity. Like, it was literally such a small thing. Well, when I tell you it was transformative, it worked. We actually have gotten most of our rescue capital back. So I think that the cycle caused us to think differently about, this wasn't your foe or your opponent. This was your borrower or your partner was someone who's in this investment with you. And that's with the folks that are on the underlying real estate. But then let me talk about our investor partners, our LPs. We have 17 LPs. They were so focused on helping and listening. And as long as you were transparent with them and you said, here's what's going on, here's how basis is addressing this, here's how we're underwriting going forward, here's how we mark the portfolio to make sure that we are not surprising you quarter to quarter. It was all about communication. And so I felt that it was very just different than the other cycles where there were other underlying causes that were much more systemic in nature, from the economy or from over-levering. And this was more about coming together. And that's so I think the lesson learned for us was communication, transparency, underwriting. And then as we go forward, it's focusing on structure and making sure that we have the right, no pun intended, basis in the real estate to basically be sustainable for what's kind of going on in some of the places where the property types are a little hot for my desire, like the multifamily, certain aspects of multifamily.
Yeah, Sam, if I can follow Tammy, I just think that's great, Tammy, and super smart. And I think really representative of the people who rode through this last 18 months the best from a partner perspective. When I think about lessons learned, the first thing that popped into my head was people. We are looking at investing with people. And secondarily into strategy, investment strategy, because, like the crises, each crisis show that, people will behave, their true colors come out, right? And you either wind up with partners who are going to be transparent and accountable and aligned with you, or you've got folks who go their own way. And so, I think that's just an enduring lesson that has been yet again kind of demonstrated in COVID.
So let's talk, because I know we're going to get the gong soon, but I want to have this conversation about recovery. It's all over the place, I think. It's a mixed bag. So you've got, and everybody's got an opinion, whether you're an owner operator, whether you're an investor, whether you're a financial institution. Some say, the effects of the global pandemic have run its course, and we're done and that's it. There's no more opportunities. Others say, whoa, let's wait a minute. There's still more to come. You have some of these, the government subsidies in place that are going to run off, and so there's going to be something coming forward. So give me your thoughts, Jillian. Recovery, yes, no, are we in it? Where are we? And if you think yes, we're done, when did that start? And did I blink and miss it? Or if no, give me your thoughts on what you think we're going to see going forward.
So 70% of our portfolio is multifamily, 18,000 apartment units across the country. I really, I said it earlier, I think we did 2 deals, the 2 Dallas apartment deals, that we actually got a quote-unquote focus. I think if you weren't, back in the market in that 60 to 90 days, March, April, May 2020, there are no total discussions. I think there were some investors who were back on board for that and realized that that's not happening. Cap rate compression.
Wait, I'm having a hard time, Jillian. I think something's going on. Is it just me, Tammy,
No.
Christy? Is it you?
No, that's what it is.
Okay, so let's try Jillian again.
Everything okay?
Something's squealing going on in the background. I'm not quite sure.
Go to someone else. I'll try and fix this.
Okay, Christy, you want to jump in?
Yeah, recovery.
Recovery, yes, no, did I miss it?
Well, I think, as we were kind of chatting before the panel officially started, there's a tremendous amount of uncertainty out there again on so many different fronts. And so I'm not sure where I would put my money on the recovery bet, but I think we all have to be very careful. And, back to our earlier point is look at each investment singularly, be as risk aware as we can, structure investments to reflect those risks, and just try and be as defensive as we can until we have more visibility into how the pandemic will play out, until how some of the legislation will play out, tax, infrastructure, other, into a whole host of things. It's just a very complicated world, and so I think you just got to stick to basics and see how it all plays out. It's been nice to see the recovery and the return to the recovery in cash flows that is so many properties, and the recovery to capital values in so many places. But I still feel like there's a lot of vulnerability in those recovery metrics. So we'll see.
Yeah, agreed. And, we didn't even talk about, when we were talking about the phases of COVID and the effects, we didn't talk about, we had a little political issue happening right in the middle of that. And normally, particularly given the switch or not, the two, the divisiveness between the two parties, that would have been a bigger conversation, right, about how that affects. So in some ways, I think, the pandemic and all that was going on in the pandemic took precedence over that, but that's still a factor, because our policies and things like that. Jillian, do we have you back?
Let's try it. Can you hear me okay? All right, good.
Yes,
sorry about
perfect.
that. Technical difficulties, right? One of
Yes.
the
with our fintech,
working from home joys. Yeah, I mean, I was saying the majority of our portfolio is in multifamily. So we are investors in over 18,000 apartment units, and it performed tremendously well during COVID. So I think that you're not going to see any more of a recovery there. I'd say, if anything, I'm cautious. One of the things that I don't hear people talking a lot about, but that I'm cautious about, is because of the eviction moratorium, you're seeing occupancy higher than it normally would be, right? And don't get me wrong, I still fundamentally believe in this country that we've got a mismatch between supply and demand, particularly in workforce housing. Similar to Tammy, we've been very active investors in workforce housing and affordable housing. We still really like that story. But the occupancies are being pushed up irrationally, right? Because of the eviction moratorium. So I think that there may still be a slight adjustment in multifamily as far as NOIs. That being said, I don't actually think cap rates are going to move because there's so much demand. People just cannot put money out fast enough in multifamily. And one of the things I spent a lot of time internationally growing up and through university, and you look at cap rates in markets like Tokyo, right? And you look at cap rates in markets like Germany, and they've got negative interest rates in some various countries, and their cap rates are 1-2%. So does LA, New York, San Francisco suddenly become 1-2-3% cap rates? I don't know. What I can tell you is that I just had a deal across my desk that was in Arkansas at a 4 cap. When Arkansas is trading at a 4 cap, there's something up. Right? Like red flags, shining. And we've actually been one of the shops that have said, we're going to go back into the major cities. So the same way that, we dove in, I think what was early when we made a commitment in April, May of 2020 to invest in Dallas and to continue putting capital out in the multifamily side, like we're back investing in Los Angeles. We're back investing in Chicago. We're looking actively in New York, although I think New York now has been, bid up and you're starting to see tremendous recovery in New York that's actually faster than I was expecting. The big question is, when do you see recovery in hospitality? When do you see recovery in office? I don't know. And as a result of not knowing, we're out of the hospitality world. We're very cautious on office. We'll still do, triple net office, credit tenant, covered leasing type stuff. But on the, small tenant, diversified office, suburban or core markets, we're pretty cautious today.
Yeah, we're having a conversation next week with Owen Thomas, and I, can't wait to dig in with him on that. I sat on a panel discussion with a guy from a very large New York-based firm. All they do is office, and he said on that panel, office is back. and everybody kind of just lost it, because it's not, particularly New York City office. I'm a New York girl as well, born and raised in, but I'm a New York girl, wanted to be back. The bottom line is we don't know. There's so many things that we have to work through. And I think it starts with the companies themselves, right? How are companies resetting their model, how they are working, how they're allowing their people to work, and then how does that affect space that they need and space that they use? So I agree 100%, Jillian. We don't know. And we need to be okay saying that, and be okay saying that we have to watch it, because I do think there will be opportunities, but we need to watch it first, because the companies are going to set the tone. And it can't be the Googles and the Amazons of the world, because they have a different, they can buy up lots of space and control, kind of the different aspects of what it means to go back to work. Whereas the smaller, multi-tenanted buildings, we can't do that. I mean, we're 20 people. We have little say in all of that. So I think it's, very interesting. I see Michel's face, so that means we're kind of getting the gong. I don't know, Tammy, did you want to add?
Yeah, no, I was just going to say that I love the example that Jillian said about Arkansas and the 4 cap, and kind of just to add a little bit to that, what we're seeing is going in cap rates at 4, but people believing that there's some upside, whether it's, burning off of concessions, whether it's, resetting of rents, that the exit cap is that's the story that we're seeing. And it's a hard story to believe in certain markets where you say, well, how much real rent growth will there be? But I will tell you that, depending, again, back to the whole, not every geography is created equally, you will see places where, although occupancies are 95%, there's still free rent that's burning off in certain, and that's multi and office, and concessions have been a way that people attracted tenants into these properties during COVID. So it's an interesting and complicated story that I think we all just have to, put our underwriting hats on and really step back and look at sustainability and kind of think about where are we. And one final point, you talked about the election. Well, what about climate change and the hurricanes and, all these things that affect a tangible asset like real estate? We have to really incorporate that. That's part of ESG into our thinking, because our investment class, unlike stocks, is tangible. And, every time we have another weather event, a fire in California, we are checking our portfolio. It's a real risk that all of us have to, floods, the floodplain, all those different things that we just need to make sure that we're focused on.
So if I can, before I turn it over to Michel, I just want to kind of touch on some themes and takeaways. And then, Christy, Jillian, Tammy, if you want to add to that. I think what I've heard is, one, it's all about solutions, right? It's kind of individual approach to not only managing your existing assets, but how you think about investing going forward. It cannot be a commodity investment strategy. It's really got to be individual solutions. Two, it's about the people. I think that's the biggest lesson learned that we've learned over the years. And I think people forgot it in the global financial crisis, when they didn't place enough emphasis on who the team was, how long they've been together, how they get paid even. And we found people just kind of leaving firms and leaving investors. So the focus on people came back. And I think that's another big theme and takeaway here. And then the third is relative value. You cannot treat every property sector, every market, every life cycle the same. You have to have a relative value approach when you're looking at what property sector is going to perform best in what market, and what the strategy and structure or life cycle is of that investment. So you may be able to do some multifamily development and not pay a 2 cap. You may be able to do that. So those are the takeaways that I think we've come up with today.
Good.
Awesome. Awesome. So I'm going to turn it over to Michel, but before I do that, thank you, Christy, Jillian, and Tammy. As always, I was saying earlier that these are, titans in this industry. They are CEOs, they are principals, they are leading investment decision-making, and that is critical. And I am so happy to say that these are my friends as well. So love the company I keep. Thank you all so much. Appreciate you.
Indeed, Sam. I have a couple of questions here coming. Distressed. Why are we not seeing more distressed opportunities in office and even retail and hotel sectors at this stage? Anybody? I mean,
I'll jump in. I was just going to say there has to be the capitulation of where you think you're going to, where buyers and sellers come together. And I just don't think in this, everyone had even though it's now, 18 months or whatever the time frame is, people still feel like if they can ride the storm and they can get through vaccines, that they don't want to walk away from, recent equity that they may have invested. And so I do feel that if you have the ability to feed your assets, and that's why structures like that rescue equity that we came up with really helped folks to hold on to their properties, you will be able to weather the storm. And so I don't think that the great financial crisis, we had different reasons for the disruption. Today, we have what we would hope will be, a place where valuations were temporarily impacted. But if we're able to get back to, rents pre-COVID, if we're able to get rid of the concessions pre-COVID in certain property types, I think that there just hasn't been a feeling that owners should part with their investments unless you have a liquidity issue where you're getting marks from your line providers, or you just have literally run out of capital, or you feel like putting good capital into these investments makes no more sense from your return. And we just haven't seen that yet.
Yeah, I think everybody was just, broadly speaking, not as highly levered this time around as they were going into the GFC. And there just wasn't as much pressure on banks to disgorge assets as there was post GFC. So to your point, Tammy, I think everyone was doing a little bit more of working together to keep owners in place and the buildings operating.
But on that same topic, why were lenders and servicers more receptive, Christy, for temporary and short-term arrangements than during the Great Financial Crisis, for example?
Well, I think part of it was everyone was trying to figure out what was happening in the world. And so it was difficult to make kind of broad kind of decisions about their books in the face of the pandemic uncertainty. I also think the banks were in better shape just overall and had more room to kind of sit and, let things play out a bit and work with their borrowers. And I just think the completely different nature of this disruption, just had everyone kind of a little bit more in a safety frame of mind and, trying to figure out, what was going to be the best path forward. So I think it was just a host of things.
Mm-hmm. You've all mentioned that the market right now is hot and relatively depending on the asset type and sector, but are you selling right now into this hot market and deploying?
We're actively selling. So we're always sort of actively buying and selling depending on the asset, but we're actively selling. A lot of the assets that we're selling, to be totally honest, are those where I'm concerned about climate change risk. Mm-hmm. So if there are any assets where I'm concerned about climate change risk, given the cap rate compression, those are assets that we're looking to sell. If there are assets that we've held, in accordance with sort of their hold periods and the business plan is done, we're actively selling assets that look like that. So we're being, selective around those assets that we think make sense to sell. The challenge is it's very hard to replace that yield, right? If you bought an asset 5 years ago and you've refied, potentially you have a decent portion of your basis back, and where do you redeploy that yield? That's a challenging piece of it.
That's the thing.
But we're absolutely an active seller in today's market, in addition to being an active buyer. So I think that's an important point. But climate change, we didn't talk about it on this panel, but that's something that I'm really concerned about, and we're having conversations. Even properties that are 3, 4, 5 miles off the coast, we've had a conversation around like, what is the risk? How do we quantify it? And is that an asset that we're willing to hold another 10 years?
So I guess that's for the three of them. And you touched that as well, Tammy, is three of you see a growing importance and value in ESG and impact investment from your investors and clients? This is definitely growing.
I'll jump in and say that, can't talk a lot about my fundraising efforts, but I can say when I was in the market earlier with my fund, and based on some recent discussions, I'll just give you the example of the due diligence questionnaires. Used to have like one page on ESG. Now it's like 16 pages, which is I'm excited about, because that is telling me that investors care. As you guys know, I'm on the board of sit on the board of 2 public REITs. And, the public, first of all, internationally, you guys were ahead of the US in ESG. And then the public sector has actually gotten more ahead of it as well. And now it's starting to come into private equity. And what really I've learned, and I think hopefully as the leader and CEO that I'm bringing to the company, is that ESG is not just good for execution, it is execution. Everything you do, your stakeholders, how you invest. And with real estate in particular, there are so many opportunities, for, water utilization, trying to track that or reduce that, making sure that you have energy efficient, properties, LEED certified properties, making sure that we're partnering, because we're allocators of capital, with people who care about the S in ESG, the diversity aspect. And there's just so many different things. And Jillian's right, focusing on, climate change and making sure that we're figuring out how to do what's right for the planet, because ultimately we're all, going to be affected if we don't deal with certain coastal properties. And we are also, I was going to say before, Michel, we're also sellers of assets. And what we've noticed is you have to look at the yield, but also you have to make sure that you're not missing the window of where you can get for industrial properties. I can't tell you, we have 2 deals where we sold that in with multiples, multiple increases against our business plan. And so you also have to look at that opportunity as well. So there's definitely a dance and a trade going on.
Yeah, one more note on the sustainability side. We can speak publicly about deals that we're raising capital for, and we're raising capital for a deal right now that is a solar play. It's a master metered property. One of the challenges with solar is when you have separately metered property, it's very hard to implement. So they tend to be older assets. But we partnered with one of the most knowledgeable solar energy sponsors in the multifamily market, and it's a master metered property. We're planning on offsetting 100% of the electricity consumption through solar. So we're really, really excited about that. We launched a sustainability program about 1.5 years ago. This is our first deal. So it's challenging to find those sustainable deals, solar in particular, because you need master meter multifamily. But we're excited about it. Our investors are excited about it. And I think you're going to see more and more of it in the real estate sector.
I see Ken McIntyre joined us. Ken, you want to say a couple of words on REEC or any comments you want to add or questions?
Well, thank you. One is I just want to say how much I enjoyed this wonderful panel. It's as Sam said, it's a great panel of experts, and Sam did a wonderful job as a moderator. But REEC follows what we're doing at REEC follows a lot of the themes that you're talking about here. And one of the big themes is that real estate has always been about diversification, as is all investing. And so what we're seeing is there's more diversity in commercial real estate, as evidenced by this panel. However, we know percentage-wise, the numbers haven't been accelerating like we like to see it with respect to diversity. But in absolute numbers, there are more people of color, there are more women in important positions, what we refer to as executive positions across the industry. And we as an organization are striving to support that pipeline and support that talent in the industry. The other theme that I think you've touched on that I would talk about is intentionality. And things change because people are intentional about making change. And the investors here have been intentional about how they have changed how they pursue investments, how they underwrite investments, how they look at how this pandemic is affecting what could be happening in the future. We're seeing the same thing from companies with respect to the goals they're trying to set and achieve with respect to diversity and inclusion. And so REEC has positioned itself to be a partner to help organizations, firms meet their DE&I goals across different dimensions, whether it's people, the workforce and talent, or whether it's where you want to invest your money, or where you want to spend your money, supplier diversity. We are the answer to how can you get assistance in achieving those goals. So thank you for the opportunity to co-sponsor this panel, and appreciate the time for a few words here.
Thank you, Ken. Appreciate. Wish we would have more time. We're over our hour right now, and I think we could have continued for another hour easily. What do you think, Sam?
Michel, we talked about this and I tried to be prepared for this. Like I said, I know this group of women and just the information flow coming from them. It's authentic, it's genuine, it's timely, it's interesting. We're not talking about the basic things. So you're right. Next time, I'm going to give a little bit more time to this group.
Thank you so much, Sam, Tammy, Christy, and Jillian, and Ken. Better understanding where investors and capital sources are targeting their dollars and how properties and projects are being funded benefits us all. On-demand recording are available to most What's Next session, including today's. I encourage everyone to visit cre.org/webinars for information on other topical and thought-provoking programs in development, including part 2. That's next week. On September 23rd, Thursday, when Sam and her guests will dive deeper into the property sectors. Again, until then, on behalf of the Counselors of Real Estate and Real Estate Executive Council, thank you for attending this session of What's Next for Real Estate and Life Experience. Thank you again.
Thank you so much.
Yeah.
Be well.
Take care.